תודה רבה. עכשיו נרצה לעבור ללונדון, לדבר עם מקסים רבניקוב, האנליסט הראשי של דירוג החוב הריבוני של ישראל ב-S&P. And now I'm honored to welcome Maxim Ribnikov, Director, Primary Credit Analyst, S&P Global Ratings. Hello, Mr. Ribnikov.
Hi, hello. Can you hear me? Hopefully the technology is working.
We can hear you.
Okay,
We can't see you now. We also
Excellent.
see you. Hello, Mr. Ribnikov. Hello again. Thank you for joining us from London. How are you? How is the situation in London in these confusing Corona days?
Well, thanks a lot for inviting me. It's good to speak at the conference. I think the situation is improving. UK has really caught up with Israel in terms of vaccination levels, but as you can probably tell from my background, we're still sort of working from home, but hopefully that will change, and maybe one day I'll be able to make it to Tel Aviv in person.
Okay, thank you. Also in Israel, we are not that sure how is the situation, and now we will be glad to hear from you about Israel's sovereign ratings, outlook, and cross-country comparison. The stage is yours.
Yeah, absolutely. Thank you so much. So I'm going to move the slides, which you hopefully can see. So I'm going to speak about the Israel sovereign ratings, the outlook for the medium term, and compare it with developments in some of the other countries. But first, I will start actually with the latest S&P Global Ratings economic outlook that we actually just published a few days ago at the end of June. I think that provides sort of a useful background to the rest of the conversation. So to dive straight into this, basically, the key message from the outlook that we published lately is that the global economy is picking up steam, fueled by vaccinations. And the script has overall flipped from that of more or less damage control, where countries were doing lockdowns, test and trace, and things like that, towards driving to the end game. And we think that basically, across the world, the effective end of the pandemic is approaching, particularly for the most advanced economies. And that's actually happening somewhat earlier and faster than we previously expected. We see widespread vaccine availability, the complications from COVID in terms of hospitalization in many countries are going down, although of course some uncertainties remain regarding new variants, but overall I think the uncertainty is subsiding. And the macro outlook is continuing to improve on that basis. We've seen a stronger performance almost across the board in developed and emerging markets alike in Q1 2021. And subsequently, we revised the global growth outlook to 5.9% in 2021. That's up 40 basis points from our previous expectations. In terms of the risks, on which I will say, a couple of more things shortly, I think, the balance is basically shifting from controlling the pandemic and being generally pandemic related to those of exit and rebound, including rising inflation in the US, transition for emerging markets, and normalization of policy, which is also very important, of course, in Israel, particularly for fiscal. So if we look at the numbers for our economic outlook, you see that for the US, for example, this year, we're expecting 6.7% growth, 7% growth for the UK, for the world overall, almost 6% growth this year. And in the table to the right, you can see in the latest forecasting round, it's almost, universally a revision of growth up. Those are, these green boxes. There are a couple of red boxes, but in some cases, they're not bad. For example, for UK and Brazil, it basically represents that we expect the recovery to happen earlier. So there will be more growth in 2021 and slightly less in 2022. Of course, there are some downward revisions as well, but overall, the picture is notably improving. So what are the key risks for this economic outlook? And I think, much of it is also very relevant to Israel, and we'll cover it in a bit more detail very shortly. So the first risk that we have highlighted in the latest outlook that we published is that of a rise in US inflation. And I think, the base effects from lower prices last year, from a collapse in oil prices in April and May 2020 were widely expected. So year-on-year inflation was projected already earlier to pick up in many countries, including the US this spring. Nevertheless, when it actually happened, with inflation surpassing 5% year-on-year in the US, I think a lot of people were still very surprised. But for now, we are not overly concerned about this, and we think this will be, transitory. The second risk is that of uneven recovery, and I think, the different sectors of the economy in Israel and in other countries will be more or less facing a similar set of financing and economic conditions. So the worry is that at some sector levels, as policy normalizes, if the sectors are lagging behind, for example, some services sectors, including maybe tourism being more slowly to recover, they will face more trouble as the previous support schemes are discontinued. And that also applies to maybe slower recovering in emerging markets where vaccination rates remain much lower than in DMs. Non-credible exit strategy is another risk. So, how do we get the policies? How does the world get the policies back to more sustainable levels, withdraws monetary stimulus in an orderly way, and gets fiscal positions to, basically amend after what was a substantial deterioration in 2020. And the last risk is, of course, pandemic and health related, but we think that's, receding because vaccinations are picking up. So Delta variant is, of course, a concern, but we still see that hospitalizations are much lower at this point than during the previous waves of the pandemic. So very briefly on a couple of other issues before we move to Israel. So should we be worried about rising inflation? The short answer from us is no. We expect in the baseline an orderly reflation. We think the base effect will soon fade, improving the numbers somewhat. And we think that much of recent pickup in inflation is driven by supply chain disruptions, including widely reported issues, for example, in the semiconductor industry. As those issues, as industries get over these supply constraints, we think that inflation will gradually moderate, and there are already some signs that expectations have started to come down. I think a somewhat bigger worry for us is the performance of emerging markets in terms of vaccination, and I think that matters not only for emerging markets, but of course also for other economies that are exposed and trade with them, and for some companies in the developed markets which might have exposure to EMs. And here we can see really very significant differences in vaccination rates. So Israel, according to the data that we compiled here, is actually number 2. I think for a long time it was number 1, at least according to the, this metric that we're tracking, which is the people with at least one dose of the vaccine. So that's over 60% in Israel, just slightly behind the UK. G10 countries highlighted here in the green bar are rapidly catching up as well with 50%. But you can see that emerging markets in general are very far behind. I mean, on average, the vaccination rate is about 20%, but in a whole lot of different EMs, particularly in Africa, the rates are significantly lower. And of course, that, creates concerns over the pace of reopening and economic growth going forward. So now moving specifically to Israel, let's first look at the sovereign ratings and how we assign them in general, the sort of strengths and weaknesses of the rating specifically for Israel, and then we can also do a quick comparison of some of the metrics in Israel vis-a-vis other developed markets. So the first thing I need to say is, as a credit rating agency, our mandate is really to assess credit risk. So we're assessing, the likelihood of the government paying on time and in full on its financial commitment. So it's important to remember that we analyze, other factors, including the economy, business environment, etc., but only to the degree that it actually applies to the ability of a specific government to service its debt. So within the this perimeter, the sovereign rating methodology, basically, which is a publicly available document on how we assign credit ratings to countries, lists 5 key factors that basically comprise the sovereign rating. Those are the institutional and economic assessment on the left-hand side here, which comprise roughly 50% of the rating. Those are more sort of fundamental factors. And then we've got the external assessment, which is sort of balance of payments, fiscal and debt assessment, and monetary assessment, which comprise the other 50% of the rating. And that, those 3 factors more or less reflect the government's policy leeway, the reaction function that is available to the authorities to smoothen the fluctuations in the economic cycle. So today, the rating on Israel on foreign currency obligations is AA-, and the outlook is stable. We published our most recent ratings report in the middle of May. The Israel's rating has been at a AA- level for quite some time, actually, since August 2018. And before that, it has been on an improving trend with an upgrade happening, in August 2018. This is a very high rating level if we compare, globally, even vis-a-vis other developed markets. So in terms of the strengths and weaknesses of the rating, you can see on this right-hand spider chart, basically the factors that I just mentioned in the previous slide. They are scored on a 1 to 6 basis, with 1 being the strongest and 6 being the weakest. And we've got, here for Israel, very strong economic performance, very strong balance of payments, functioning monetary policy as well, somewhat weaker fiscal position, which I guess you will not be surprised about. And that has already been the case before the pandemic, with some structural deficits in Israel public finances. And the institutional assessment is actually also a weakness for the rating. So if we look at the factors that can change the rating, up or down at this point, there are a couple. So overall, we see risks at this point as balanced. So we've got, elevated still political and security uncertainty, which I think has been a factor in place in Israel for many years. But that is balanced by the persistently resilient economy and strong balance of payments, which also offsets the deterioration in fiscal position that we have observed. So in terms of the upside and downside triggers for the rating, I think, fundamental reduction of political and security risks could be one factor that could lead us to revise the assessment up, while the fiscal outturns being materially stronger can be another factor. And almost, mirroring that on the downside, the return of political volatility, again, escalation of security risks, as well as a deterioration in fiscal position could drive the rating down. Institutional assessment, as I said, is a rating weakness, which maybe is, somewhat surprising. I think in terms of the economic factors specifically, we've seen a very robust economic policy in recent years. Growth has been very strong. The contraction last year was less than in other countries. And the government came up with a pretty effective package, like other developed markets did, to cushion the impact of the pandemic on the domestic economy. But at the same time, fundamentally, we've got in Israel less cohesive civil society, external security risks. We've seen, an escalation of a conflict or a war very recently, which reminds us, that these things are still there, and that's a constraining factor for the sovereign ratings. And of course, we've had elevated political volatility in recent years. On the fiscal front, I think we're sort of less concerned as a rating agencies than maybe some other people and market participants might think. I need to say here one thing maybe is that, rating agency and credit rating is more than just about, fiscal and debt accounts. We'll look at a whole range of other factors that I highlighted earlier. And in fact, some of these factors correlate with the default probability much more than, the ratio of net general government debt to GDP. Obviously, as a result of the pandemic, we're looking at a very significant deterioration in net general government debt in Israel. So by 2023, we estimate there will be a 17% of GDP higher debt level in Israel vis-a-vis our pre-pandemic projections. But at this point, in a nutshell, we're sort of not as worried about it, although I know that the market and the press, I think, in Israel is quite sort of concentrated and constantly asking us, well, as a result of this fiscal deterioration, what does it basically mean for the sovereign rating? And we're not too worried for the following 4 reasons. Number one, Israel has highly flexible monetary policy with central bank basically backstopping the government financing requirements. There's a strong access to capital markets, even external and in foreign currency, with issuances ranging in maturity between 30 and 100 years. Favorable debt structure, which is mostly denominated in domestic currency and held domestically as well. And of course, there's still some room for fiscal adjustment. And, compared to some of the other developed markets, I think net general government debt in Israel is still somewhat less than in those other countries, which we will see in a couple of charts very shortly. So in terms of the baseline economic outlook, specifically for Israel, we are looking at a 5% growth this year, following a relatively mild contraction of 2.6% last year, particularly compared, as I said, to other developed markets. Few things are driving growth. Obviously, good vaccination progress, the tech sector, which is probably one of the very few sectors globally benefiting from the pandemic. And there's another factor in Israel, which is the rising gas exports. So all of that is going to underpin a pretty good growth outlook. And, that is happening against relatively contained imbalances. So we do consider that the current account deficit will remain in surplus. The country will remain in a net external creditor position overall. We do assume that the inflation rise will be transitory. We don't expect a significant pickup in inflation over the medium term, and that net general government debt in Israel will gradually stabilize as the new government moves to get, public finances under control. And I'll wrap up this presentation by showing you just a couple of charts comparing Israel to other countries that we rate. So, this chart here basically compares the increase in overall debt level in Israel between 2019 and 2023 in percentage points of GDP, and puts it, against some of the G10 developed markets. You can clearly see that Israel has experienced a pronounced rise in debt, of sort of 25 percentage points of GDP or so, depending on, what level of GDP you use, of course. So this is very substantial, but it's less than for some of the other countries like Canada, United States, United Kingdom. So, that increase in a way is not unique. In terms of the overall level of net general government debt, I would say that, among the developed market peer group, Israel is right in the middle, right? So we have a few countries with much higher leverage than that of Israel, but we also have a few with a lower level like, Germany, Canada, Netherlands, Sweden, and Switzerland, for instance. One last thing that I would like to highlight, which I think is very important for our analysis of the sovereign ratings, is the net external asset position of the country overall. So overall, Israel has external assets which exceed external liabilities. If you look at the left chart, of all the 140 sovereigns that we rate or so, this is more or less the top 20 with the strongest net external asset position. And Israel is one of them. It might be looking at the bottom of the chart here, but it's sort of the chart of the strongest sovereigns on this metric, which historically we found correlates very well with, the probability of default. So the more external assets the country has on a net basis, sort of the less the likelihood of credit-related stress. And many of the sovereigns, notably on this chart on the left, are commodity exporters, but that is not the case in Israel, and it still sort of shows up as one of the top here. So I guess I'm out of time, so I probably will stop here. Thank you very much.
Thank you very much, Mr. Maxim Ribnikov. Thanks for joining us from London, and thanks for your interesting forecast. Thank you. Have a nice day.
Yeah, thank you. Thank you for inviting me.